Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Stephanie Roth joined us from Wolfe. It was really quite good about the moment. None of that mattered. The conversation is ancient history. She joins us for a reset after what we've witnessed in the last, say, 72 hours as well. I don't want you to do a what if. I want you to do how the Fed ex post, waiting for data, adapts and adjusts to the instabilities coming out of the Oval Office in 1600 Pennsylvania Avenue. Don't tell me they just ignore it.
Well, they don't just ignore it, but they probably don't do much because it doesn't make sense for them to be cutting if there's the potential for tariffs to be moving inflation expectations higher. Are they
more frozen than they were 48 hours ago?
No, probably not. Here's the thing. Here's what we learned, right? Tariffs on Canada, Mexico, that's what was really going to impact the U.S. economy. That was going to be a real inflationary force. Could have boosted inflation by 50 plus basis points. It got delayed a month. Base cases, they probably just don't happen. I think that's what the message was. Trump probably wanted to do the China tariffs regardless. So the fact that was a much smaller 10%, that was probably going to happen either way, and he's going to continue to ratchet up tariffs on China. The Canada-Mexico ones made a lot less sense, especially when we're talking Canada.
So have you adjusted your inflation outlook at all for these tariffs, or are you just kind of waiting to see what actually gets enacted, if anything?
So based on our numbers, the China tariffs could boost inflation by about 10 basis points this year and hit GDP by about 10 basis points as well. So at this point, I'm just going to wait and see what happens in the next 2 weeks. Could that be plus or minus
Jobs
10 basis points? Sure.
The rest of it.
But we're not assuming certainly any of the broader tariffs go into effect at this point.
I'm absolutely fascinated by Atlanta GDP, which is a squishy number, out near 4% real GDP. Let's say that's an anomaly. But do we just continue to get the growthiness surprise that has made up the last 18 months?
At some point, it will probably cool down, but we're still looking. We're waiting, and we're still looking.
That's what Jerome Powell's doing.
That's what Jerome Powell's. And there's a couple of things that are truly boosting the U.S. economy, and equity valuations are a big part of it. Net worth in the U.S. economy has been incredibly strong, over $15 trillion above the prior trend. And if you assume a couple cents on the dollar, that's a real boost to consumer spending, something of the tune of 1% to 2%. And then, by the way, crypto, which doesn't go talked about quite as much, but there's also real wealth there, and the marginal propensity to consume, or the desire to consume for every dollar of wealth in the crypto space is higher than what it would be in equities.
This is important. You think the PhDs at the equities building, the Eccles building, are looking at the marginal propensity to consume a BitDog?
I think they're starting to, because it seems like there's a legitimate impact at this point. You can't really ignore it.
All right, Stephanie. So, what is your GDP call for 2025 and 2026?
GDP for 2025 is 2.2, inflation of 2.3. 2026, we're looking at something closer to 2%, but I'm starting to get worried that tariffs will become a real issue for 2026, which would then put GDP below 2%.
And is that driven by, again, the consumer is 70% of this economy, so having any growth this year and next year implies that you have some confidence in the consumer.
I do have confidence in the consumer. The consumer is doing just fine, especially if they don't get hit by these massive tariffs, at least this year. They have wealth in equities and real estate. The labor market is just fine. We didn't talk about that, but jobs are probably going to print another solid one this month. Yep. And that's what drives the consumer. They might be upset about the price of a lot of goods, especially when it comes to groceries, but wages have largely kept up with a lot of those goods.
Mm-hmm. Jason Furman does a lot of work on an ecumenical inflation call, looking at different summed annualized returns, 3-month annualized, 6-month. All of them are sub 3% as a general statement. Will the shock that we see out the next 3 months, out 2, 3, 4 Fed meetings, be one or some of those annualized returns being under 2%?
I wouldn't bet on the Q1 numbers being under 2%. Fair. Because we still have seasonal problems that have yet to be addressed in the data. But Q2 certainly could be.
Wow. I mean, that's a wow observation.
Yep.
And that inflation, OER finally becomes well-behaved and real estate becomes well-behaved. Is that enough to generate a rate cut discussion? I just don't buy it, given the political madness in Washington.
We have a rate cut in our forecast for May, but to be fair, that one's very much in question.
Would you like to make some news here?
Certainly not. But that one's going to really rely on the employment data in the next couple of months being a little bit softer and inflation being subdued. We're going to have to get past the first January, February, March prints in terms of inflation, because that's where you see the real seasonality problems, and that's going to continue again.
Well, on Friday, we are going to get the change in non-farm in payrolls, and 170,000 is the consensus.
How quaint, a normal discussion about Friday.
Exactly. We had that big print last month of 256,000. What is your view of the labor market? I mean, we're going to get some people are concerned that, okay, nobody's firing anybody, but nobody's really hiring either. How do you think about the labor market?
Yeah, the labor market's doing okay. There's been a lot of volatility when it comes to strikes and bad weather, so it's hard to look through it. But our base case is the trend in payrolls is somewhere around 160,000, which is really quite solid. This year is gonna present some challenges, though, because immigration trends are gonna be going the other way than what they've been the past couple of years. So a lot of people, we're estimating about 3.6 million people are gonna lose their visas to work over the next 2 years, which will pose some challenges for the labor market. And a lot of that roll-off's going to happen in the back half of this year.
Have you looked back over the last 3-4 years about migration, legal and illegal, how that contributed to the labor force? Because it feels like it's been a fairly significant driver.
It's probably one of the single biggest reasons why the Fed was able to actually rebalance the economy without causing a recession, is because we got the supply side of the labor market actually helping to bring down inflation. So we didn't need the demand side of the economy to slow down quite as much. Now this is going the other way, which is to some degree okay, because now demand for labor has cooled compared to where we were 2 years ago.
Okay.
But this could present some challenges. We might start to see wage inflation pick up towards the back part of this year as labor supply again becomes constrained.
Paul mentioned this, and Anna Wong at Bloomberg Economics has provided global leadership on this. And this is the 14th, it's like Howard Johnson's. It's like the pistachio revision or the butternut, maple nut revision. The revisions, like this jobs day, are there one or two to study? Or is it just chaos through the spring and revisions of the job market?
So this is going to be a chaotic report because we because we get annual revisions to both the headline jobs numbers and then also the data that is associated with the unemployment rate. What's gonna happen is we're gonna get a large upward revision to the population, which is tied to the measure for the unemployment rate. So it's going to be very confusing. You can't compare the January reading to December numbers because the revisions kind of don't work so well that way. But so there's going to be a lot of noise. The combination of massive revisions to the prior years. By the way, they're going to be adding 3.6 million people roughly to the labor force that weren't previously there. And then we also have the impact of the fires going to be impacting the payrolls numbers. So that's where there could be a surprise that might be difficult to sort of decipher.
Okay, so what's the summary here? Are we going to see a higher unemployment rate, or do we shock with revisions and go to 3.9%?
So for this print, we're looking for 4.1. Because they're going to revise both the numerator and the denominator. So in theory, it should be all kind of okay.
Lisa, help me here. This is the differential equations part of the show. They're moving the numerator and the denominator, a wise one?
Yes, they're moving the numerator and the denominator. Our base case is
which partial differential is most important?
So what we'll see is we'll get a little bit of upward pressure on the unemployment rate because there's going to be more people that have a slightly higher unemployment rate. So just the mix shift of people will be slightly higher in terms of unemployment rate, but it shouldn't be massive. The thing that we're going to see over the next year, which is important, is that the unemployment rate will probably nudge down throughout the course of 2025 as labor becomes constrained as a result of immigration trends being pulled back pretty substantially.
Interesting.
See, when you were in class, and everybody was pulling a quality C.
Yep.
Stephanie was up in the third row.
Taking notes.
Nailing the curve, shift it right out to an AAA+. We hated her.
Yeah, gentlemen C, I was planning my next tea time across the street at Duke Golf Course. Stephanie, step back here. Talk to us about just a little bit more of a global view here. What's the impact on the global economy, on the U.S. economy, if China just does not get back on its feet?
You know, we've been pretty insulated from China's economy for the past couple of years, and I think it's going to be more of the same. The U.S. economy has been exceptional, and Chinese economy has been quite sluggish, and I don't think that's going to change anytime soon.
And there's also the European economy has been weaker than they would certainly like. Certainly Germany, with its reliance on China and with its reliance on Russian for fuel, has been challenged as well. But that hasn't seemed to really impacted the U.S. economy that much.
No, it's been pretty independent of the global cycle, and I think that's a lesson that we've learned is we've over time just shifted to become our sort of independent business cycle, and that will probably be the case for quite some time. And the U.S. economy will probably continue to remain fairly robust, and the global economy might be kind of sluggish like we've seen for the past couple of years.
Well, how's Powell doing? I mean, to me, they have to work ex post. They have to be data dependent. You were brilliant on forward guidance at the Fed Decide show, but the answer is just they have to go day by day, month by month now.
Yeah, and it's tough for market participants because we don't really know exactly what the framework looks like. They haven't set a very clear framework for how they're thinking about it, what to look for. The clearest thing that we've learned so far is a lot of it's going to come down to inflation expectations. Powell has pointed us to the September 2018 Teal book, and that basically said they had two different scenarios for how tariffs impact the economy, and the differentiating factor between whether they have to cause a recession or not is if inflation expectations are anchored.
Steph, thank you. Stephanie Roth, Wolfe Research with us, just really got a huge response when she's on. Some real clarity there about an ex post central bank.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let us talk about President Trump's fascination with the Gilded Age, which is up to World War II. There was an artist in Paris and then in America immediately acclaimed as a young lad named Gus Saint-Gaudens. And in 1914, he made a gold coin, a $20 double eagle gold coin, which is, it's about the price of a weekend ticket right now, $3,000 for that. But the answer is there was a time where there were gold coins, and they mattered, and it was a Gilded Age, and the president is fixated on that time. James Steele owns a high ground on this and joins us this morning. Gold at $2,800 an ounce is gold within a non-flexible system, a far more dynamic system, made more dynamic by Richard Nixon in 1971. Are we in a Gilded Age of your gold as we were in 1914 with the $20 double eagle?
Well, what we are, thank you for having me, Tom. And what we are is in a climate ever since Richard Nixon released us from Bretton Woods.
August 71.
Yes, indeed. I remember it. I was at Catholic school at the time. And I remember when that was released and the gold was allowed to begin to float freely and was completely freed by 1973. And gold has continued. Gold fell throughout the 90s. But on balance has risen, and we are in an age where government does not dictate what the gold price is.
That's where I want to go. Okay, we had a static, rules-driven, government-driven environment up until Bretton Woods 1944, and then Nixon destroyed it. And yet now the paper reports we've got bars of gold coming from London over to New York. You're expert on this. Yep. Are governments trying to control gold now? Trying to get us back to that time and place? I don't think they can do it.
No, and I don't think in that sense that they want to. One of the things about when we were on a gold standard, say from the end of the Napoleonic War up until the First War, and it was enormously successful. Sterling was the world's reserve currency backed by gold. But the reason that it worked was because that was at a time of incredible expansion in the supply of gold. That's when the North America, Australia, Southern Africa really opened up. So effectively, the increase in gold was like raising the money supply. And we're not in that situation now. We couldn't have the world's currencies tied back to the dollar again. The gold market isn't big enough or fluid enough in the modern times. But it worked, and it sufficed for a long period and made trade very, very stable.
Did it? But it kept the rich rich and subdued the middle class. And then we said we needed a credit expansion, and that was the overlay out of the New Deal, the Depression, and all that into World War II. So what's the next step here for gold, Paul? You bought it at what, 1,000 an ounce?
Oh, sure.
2,800. I mean, what's the next step, James Steele?
Well, indeed. I mean, and I do like the historical reference, because William Jennings Bryan said, "Do not crucify us on a cross of silver," because we were on a bimetallic.
Is Donald Trump saying that right now? I think there's some element of that.
Well, I think that what we're seeing is a geopolitical uncertainty. Uncertainty over trade and tariffs, and what gold is, it's a release valve. It allows for that uncertainty to be made visible.
So, China, where are they in terms of demand here for gold? Because I know the last several times we spoke, you really explained to us how China, the government, China, the population, are incremental buyers of gold, and that's been one of the reasons that gold's been moving higher. Is that still the case?
Yes, on balance. China is in the unusual position of being both the world's largest producer of gold and the world's largest consumer, and often the world's largest importer, rivaling with India, depending upon the year. So if you can think about taking corn to Iowa, I mean, that's what their importing gold is like. But high prices have curbed retail demand. 50% of all physical demand in the world, I'm not talking about what we trade on Wall Street or the city, but underlying demand is between China and India.
Really?
And these, and these high prices.
It's our great honor to bring you James Steele of HSBC. And I want to go to Canada. Kinross was an amalgamation of 3 or 4 companies, typical Canadian mining out of Toronto and that. But you've been to their mine in Alberta. Is it like a Disney movie? Did you go with White Fang?
Well, without speaking about, say, any one mine in particular, I have been to mines in Canada, the U.S. and Australia. It's always interesting. You have to dig deep for gold. One of the interesting things about mining is that the ore grade all over the world is dropping. We've mined a great deal of gold. About 50% of all the gold that's ever been mined was mined between 1914 and up into the 50s. And so we have to go to further and further out, like Papua New Guinea, into the jungle in Indonesia. Right. Places like that.
The gold in this Bulgari snake bracelet that Lisa's looking at for Valentine's Day, is that newly mined gold? Where does that gold come from?
It's likely to be, but the marvelous thing about gold is that it's never consumed, and it doesn't tarnish. So you could have a piece of jewelry around your neck that goes back to ancient Rome or ancient Egypt. It's unlikely, but you might.
That's the scam. You just described the scam.
You can't guarantee it, especially after it's been refined into a bar, and the bar's been re-refined.
Right. 45% Ontario, 26%, I didn't know, Quebec.
Yeah.
26% Quebec, 9% British Columbia, and the rest is a Disney movie up in the mountains they wear LL Bean boots.
We've been talking a lot about gold because it is up almost 8% this year, but silver is up 10%. What's going on with silver?
Well, silver very often, I wouldn't go so far as to say it's the handmaiden of gold.
Okay.
But it does have a correlation. What typically happens, but the big difference between silver and gold is that over 50% of silver is used industrially, and only 6% of gold is used industrially. Less than a fifth is in jewelry, and less than a fifth is in coins and bars. So industry is really what powers the demand, and that demand is inelastic. Nobody stopped making a cell phone because the silver price went up.
Okay.
But as far as the trading goes, a lot of people will look at a gold-silver ratio.
Right.
And for much of my career, it was 50 to 70, and now it's sort of 70 to 90. When it gets above 90, you tend to see silver being bought quite rapidly. So it's
Right.
also a much smaller market. So the volatility is there.
I got time for one more question. We just don't never enough time with James Steele. I know you don't do buy, hold, sell. 3 years out, 5 years out, 10 years out, gold up just because we're running out of it?
No, not necessarily, and that's because it's stored. There's a lot of gold around the world. There's a lot of silver around the world. The recycling process can be 30 to 90 days to get it back on the market, much quicker than mining.
Okay. Yep.
So when the price goes up enough, and we're at levels now in both gold and silver where the recycling element is rising very quickly.
Lisa.
And that's an element of supply that's rarely talked about.
Lisa, you could melt a bracelet and go see The Weeknd. Front row seats in June.
Genius. See?
Well, for example, we think that 1 out of every 8 or 9 ounces of gold in the world is in India, and when the gold is held almost exclusively in the hands of housewives, and when the price rises to a certain degree,
Right.
they will hand that gold in, and maybe buy something else, get some rupees, or play it like that. They're very
This
sensitive
is
to the
brilliant.
price.
James Steele, thank you so much. Never. Always come here. James Steele with HSBC, that was just scintillating on gold. Just fabulous. He is with HSBC.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to talk now about quiet money, college endowments, making a return, the huge pressures. I look at Lafayette College here, end of January, dorm infested with mice.
Oh, boy.
It's Krishna Memani's fault. He joins us now, CIO at Lafayette College. Do you have a mouse fund at your endowment? Do you have something there like to take care of the mice?
Well, I didn't expect to start on that topic, but we're working on it.
I look at what Lafayette has done. Just tell us about the last 2-3 years. What's your return? How's your return been?
The return last year was 11 and change.
So above a lot of people.
Yes,
Yeah.
we were in the top quartile as far as endowments are concerned.
Okay. Let me get right to it. The major thing we study at Bloomberg is a focus on alternative investments. Are you heavy into an alternative formula, or is it more traditional asset classes?
Okay, so I think we are heavy into private equities. We have a substantial allocation into private equities. People call them alternatives, but that's not the right way to think about it. The right way to think about private equity is basically it's a better equity. That's how we explain it. That is, you have a longer investment horizon and your returns are expected to be, or you expect the returns to be higher than the public equities by 300 basis points.
Let me ask a rude question, because Paul's too polite to ask it, which is, you make 11%, but are you saying, but we're going to get a pop from private equity because they weren't able to liquefy over the last 2, 3, 4 years? Do you look at private equity to pop that return?
So overall, from a long-term strategic allocation standpoint, we have a substantial allocation in private equities, expecting private equities over the long term, not 1 year, not 3 year, but long term, to outperform public equities by 300 basis points.
Was that not too rude, Paul?
No, it's positive. I mean, is that kind of what I think folks refer to as the Yale model? It's not just the 60-40 equities, bonds, but also alternatives to kind of generate better returns?
So, the Yale model comes in multiple flavors.
Okay. And
how people think about that, I think, is critically important. The way we think about it is our portfolio is roughly 70-30, 70% in equities and 30% in bonds. And for equities, we basically have 45% private public equities and 20-odd% in private equities.
Okay.
Thinking that those private equities over the long term will outperform public equities. So better equities is how we think about it as opposed to alternatives.
So we've had, in the equity markets, the past 2 years, very strong returns, north of 20% for the S&P 500. How do you think about 25, 26. I mean, what's your investment outlook here? Maybe given some of the political backdrop, the economic backdrop.
So that's a really good question. As kind of perpetual investors, we don't make significant changes in terms of our allocation based on what our near-term outlook is. What we are looking to do is generate something north of 8.5%, as Tom was talking about before. And to do that, we have to have a substantial allocation in equities, because otherwise you can't generate those types of returns. The bond part is really more to keep yourself sane and make sure we don't have a significant issue and concern when equity markets get very volatile.
Krishna Memani with his folks of Lafayette College and, of course, iconic at Invesco and others over the years. I want you to speak to people scared stiff now. Your hallmark is you have to participate. You got to be in the game to win. You're doing that in a college endowment now. How do people participate in this bifurcated, massively barbell market?
Well, so I think from a longer term perspective, having a decent allocation in equities is as important for us as it is for anybody else, because bonds, if you are taxable investors, generating after-tax returns out of bonds has been very difficult and will likely remain very, very difficult. Again, equity, having an allocation in equity helps your portfolio grow over the long term. And I think the key word there is long term. That's what we are focused on. That's what people should be focused on. From a tactical standpoint, that is, the market outlook today, coming into the year, as opposed to last 2 years, coming into this year, the one thing I concluded was having a view is going to be hurtful for your financial well-being, because we just don't know. There's a whole lot in play. As we found out over the last week, and as we are likely to find out over the next 3-6 months, as to where policy outlook from a fiscal standpoint, from an administrative policy standpoint, will shake out. Having a significant kind of play in the middle of all of that doesn't seem that prudent to us.
So how do you position a portfolio in a world where there is a lot of uncertainty? You may not want to take a view. Is it just quality, both on stocks and bonds, or?
Well, so, again, when you don't have a view, you get close to your benchmark, whatever that is. In our case, it's roughly, 70-30 equities and bonds, as opposed to significantly higher weight in equities. Having said that, I think the key here is risk management, making sure that you don't get carted out or don't get into a situation where you have to sell a position because things are going badly against you, and that could certainly happen. I think having a long-term view certainly helps you in maintaining your position. Not being out of position in a significant way also helps you in that context.
With your work, and particularly in mechanical engineering and all the technology work you've done, how do you state Mag 7 to very conservative, very frightened college academics popping an $87,000 all-in tuition? How do you say to them, Mag 7 and growth in America is your salvation? How do you do that?
Well, so I think those are the facts. That is, if you look at the performance of the U.S. equity market over the last 10, 15 years, it has been driven by technology. In fact, U.S. markets have done spectacularly better than international markets, primarily on the back of performance of Mag 7 or some version of Mag 7 at various points. Their profitability is extraordinarily good. Their cash flows are extraordinarily good. They are on a cash flow binge and their valuations are high. So I think the last two factors is what you have to kind of consider more from a tactical standpoint. From a long-term perspective, the tech sector is still a very good sector. And if you are going to participate in the market, especially in the U.S., participating in tech sector, which can generate outsized returns, is something that you absolutely have to do.
What you just said there, which was, classic Krishna Memani, do you get a lot of pushback from philosophy professors and, drama, the head of the drama department?
Thankfully, they are not in the weeds in the portfolio, so the answer is no. But I think what they are interested in is making sure that the college generates significant amount of return so that we can support the mission of the college. And they understand that to do that, you have to take some amount of risk, because just investing in bonds, which would be the safe way to do it, you just can't generate the sort of returns
Paul,
that we have to do.
They lost to Lehigh in basketball the other day, arch rivals. They clearly need a St. John's-like basketball recapitulation.
They could use that.
They're paying some guy out of the 76ers $8 million a year to coach the basketball team.
So, Krishna, I just Googled Lafayette College endowment, about $1 billion. But on an endowment per student, very, very high.
Yes,
and that is critical for the finances of a college or university. What are the colleges and universities that don't have that endowment support? That's tough, right?
So that's a really good question again, and we are very lucky. That is, Lafayette College is a great college, and the alumni are nuts in their support for the college, and have been very, very generous, and we expect they'll continue to remain very generous in their giving. The higher ed challenge is very very apparent to everyone, especially for students and parents who send their kids to college. The cost of education is definitely high. One of the primary uses of the endowment at Lafayette College is to basically support needy students in providing financial support. Whatever we contribute, it almost matches dollar for financial aid that we provide.
Do you lecture in engineering there? I can't imagine. Lafayette has such a tradition of engineering. Do you go into the classroom and yell at the students?
I don't think the professors would like that very much, but it's a fantastic engineering program, and I think the strength of Lafayette College is its engineering program along with humanities. That combination is what differentiates us from a lot of our just plain liberal arts peers.
How about, Paul, that active management fee right now within the mutual fund ETF business? Katie Greifeld from Haverford was in earlier this morning, looking at 7 basis points?
Yeah, exactly. 7 basis points for the ETFs. That's been a development in your career, Tom's career, my career, this growth of ETFs. How do you guys think about that?
Well, so from a cost perspective, ETFs versus active mutual funds, that train left a long time ago.
Yeah, you were on the other train to Lafayette College.
Yes, I was on the other train at Oppenheimer Funds as well, and that's why Oppenheimer Funds got sold, because I think that the flows speak the story. Yep. That is, the flows into ETFs are massive, and flows out of mutual funds are massive. The way we think about it is relatively simple, which is cost is certainly one component, but returns are also a significant component as well. So in our equity portfolio, we have substantial allocation into all sorts of diversified strategies, including active funds. We have some ETFs, but we have active funds as well. And those active funds, basically, the way we construct the portfolio is all of them have to contribute something to the portfolio, but in a very benchmark-aware way. We want to make sure that all of it comes back to our benchmark, which is MSCI ACWI.
Do you have a position in gold?
No, we do not have a position.
Why?
Well, so, again, in our construct of 70% equities, 30% bonds, assets like gold just don't fit into that picture. So it would be a speculative bet, and we just have decided that we'll stick to our knitting, things that we know where managers we can evaluate and not take on that additional volatility.
I don't know what it is, but the last 6 months or so, at Bloomberg surveillance, the nexus of Philadelphia schools, Lehigh, Lafayette, Haverford, Bryn Mawr, they're all been represented.
Yeah,
this has been wonderful. Thank you so much for coming in.
Thank you.
Krishna
Thanks for having me.
Memani at Oppenheimer and Invesco, just legendary, decided to go off and manage what, Paul, $1 billion?
Yeah.
That's
a fantastic
he's only working a 28-hour work week.
Yeah, yeah.
But, that's fine. Gets 3 months off. Are you painting houses during the summer?
Summertime, exactly.
Krishna, thank you so much. Wonderful to have you, and don't be a stranger as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Take a look at the front pages as we stagger to the weekend with Lisa Mateo. Lisa, what do you have?
All right, we're talking streaming, okay? So analysts are saying that forget those standalone streaming services. They say the mega bundle is what's going to happen. This is the way to go. They're saying Warner Brothers, Discovery, Disney, Paramount, they have to return to that wholesale business rather than continuing to build on those direct-to-consumer products. So they say this mega streaming bundle distributed by Apple,
Paul, what do you think?
Amazon, Google, or cable companies like Comcast. They say that's the way to go.
I think there's got to be something here. It's just the delivery mechanism is just nobody knows what they're paying for it, and nobody knows what they really have. And what's really interesting is it used to be almost impossible to cancel your cable subscription. Now you just click a button and you're off of your streaming service. Right. No friction
well,
there.
Like the sports thing that we saw, is there any evidence people want a bundled streaming subscription?
Probably do. They probably do. Bundles work. They worked for 70 years. I'm not sure why.
Well, you had Disney partnering with Warner Brothers, Discovery, like the Disney Hulu Max whole combo now.
Yeah, it's a mess.
But they say one company who doesn't need to bundle is Netflix. No. But the bundling could give Netflix some competition then finally.
Yep.
So.
Yeah, potentially.
Who knows? Who knows?
Next.
Okay, the head of the NFL. So you have NFL Commissioner Roger Goodell saying he is standing behind diversity initiatives despite the president's moves against DEI. We've been hearing a lot about this lately. He says their efforts are fundamental. They've made the NFL better, shows that gives them different perspectives. So that's what he's saying. Just to break down the rules, for those of you who are not familiar, it requires each team with an ongoing key position to have these in-person interviews with at least 2 minority candidates from outside the organization. But the thing is, there's controversy behind it because some people are saying they're just bringing them in just to go with the regulations and for show, exactly, and not going along with it.
I've seen a little bit of pushback from the president selected, let's change everything. There's selected companies. I think J.P. Morgan
is staying with the thing. But the head coach of the Pittsburgh Steelers, he was hired in large part due to the Rooney Rule, which is referred to.
The Rooney Rule. Okay. Yep.
Mike Tomlin. Yep. Thanks.
There you go. All right. We'll take you from professional sports to high school sports. This one stood out to me. More athletes are signing endorsement deals before their senior prom. Okay.
Goodness.
So let me just put in perspective.
Do you have an announcement to make?
No, I wish. So Adidas, they named a star baseball shortstop its newest big name endorser. He's from Stillwater High School in Oklahoma. Okay. He's likely the #1 pick of this year's MLB draft, though. He's 17 years old. But this is some new data out. It's open doors. They say 40 state high school associations in the U.S., they allow students to sign these NIL deals.
Yeah, but we're going to rip up the script here first. Lisa, you have a gifted offspring who's in the mix of this. What do you think?
I personally think they should wait until after they're done with high school. I think it's too much distraction amongst everything they're dealing with.
So the high school kids, Paul, are going to have deals before they go to Duke.
Yes, absolutely. And here's just some numbers. Brands spent $338 million on NIL deals for student athletes last year, primarily college students. That's up from $171 million in 2023, just to show you the growth there.
Yeah.
And how much they're getting paid. Okay, so these top high school athletes can earn between $500 to $2,000 for one social media post. Some of them, though, the superstars make upwards of 6 figures, multi-year endorsements.
Wow. So if your daughter does that, you can afford to go to the weekend.
That is true. Maybe I should rethink that. And it could also help to pay. Well, the thing, these kids aren't going to have to pay for college, so they don't need, I don't know. It's a whole
it's a whole new thing.
It's a whole, and the teachers and educators are against it, though. Because they're saying it's going to be a distraction.
Section 7, $2,600. Here's Lisa's running out of time because I can see the sun light up the sky. So I hit the road in overdrive to the weekend, MetLife, first week of June.
Yes, I know. Year. I got the text message already, reminder.
Yeah. Lisa Mateo, thank you so much. The newspapers. The Weeknd, out with a great new album.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.